Let us see the next question. The National Stock Exchange NSE-50 Index futures are traded with a rupee value being rupees 100 per index point. In a simple language, it is a kind of lot size. On 15th of September, the index closed at 1195. So 15th of September is the date on which the index closed at this value. The December futures last trading day is 15th of December. For December futures, the last trading day is 15th of December. We're trading at 1225. So on 15th of September, the spot index value is given, and on 15th of September, the futures index value is given to us for 15th of December. The historical dividend yield on the index has been 3% per annum, and the borrowing rate was 9.5% per annum. So the rate of interest is given and the dividend is given. Determine whether on the September 15, the December futures were underpriced or overpriced. That is the first question. So we are required to answer in the first question whether this is underpriced, overpriced, or maybe correctly priced. That is the question. I want you to tell me answer of the question in the chat box. So let us start calculating answer. Working note number 1. Calculation of number of days. Month and days. September, October, November and December. So it is 30 minus 15, it is 15 days. For October it is 31 days. For November it is 30 days once again. Then 31 minus 15, that comes to 16 days. Oh, we have to consider the 15 days because the contract is expiring on that date, 15 days. So the total number of days is 91 days. Calculation of theoretical F price. It will be calculated as spot plus interest minus dividend. So what is the spot price, friends? 1195 plus 1195 into what is the rate of interest? 9.5%. For how many days? For 91 days. Minus dividend. So it is 1195 into 3%. Again into 91 divided by 365. This is the way the futures value can be calculated. So what we can do, friends? 1195 plus 1195 into 9.5 minus 3 into 91 divided by 365. This is the way the futures value will be found. So 1195 into 6.5% into 91 divided by 365. So 19.37. But we can say yes, 19.37 plus 1195. So 1214.37. So theoretically the price should be equal to this. Okay. Now we can see that the actual price is provided to us as 1215. So actual price is 1215. Sorry, 1225. So 1225 is greater than what it should have been. So we understand that the futures price is overpriced. We have to always understand that the price that we have calculated is the correct price. If at all the actual price is more, then it is overpriced. If at all actual price is less, it is underpriced. So we understand that say actual price is more than theoretical futures price. 1225 is exceeding 1214.37. So futures price is overpriced. This is the way we are required to give answer. Now the second part of the question. What arbitrage transaction is possible to gain out of this mispricing? So what kind of arbitrage transaction is possible for the purpose of making gain for this mispricing? Calculate gain and losses if the index on 15th of December closes out at 1260 and 1175. Assume 365 days in a year for your calculations. Okay. So here we can say that's the second question and third question we can combine together, because over here the question says that say what transactions are required to be entered upon, and over here the question says that say if at all we have entered into this transaction, then in that case what is the profit or loss if at all the futures price turns out to be 1260, which is greater than 1225, and 1175, which is lower than 1225. That is the question. Now friends, over here basically this is what's the kind of question that say we want to do. So I have kept this question in the classwork. So let us see that say how to make calculation of this answer. This is going to be important. So now everybody is requested to pay proper attention that say how to calculate answer of this question. Now first of all I am telling you the overall transaction in which we should enter upon for the purpose of arbitrage. Dear students, we can see that actual forward price is 1225. It is exceeding the theoretical forward price, yes. So we understand that say we should enter into the transaction for sale index. So on 15th of September, the first thing that we will do is sale index futures for 15th of December at the rate 1225. So this is the price at which we will sell it. The question does not provide that say in how many transactions or in how many contracts we should enter upon. So I am taking into account only one contract, or you can take into account the multiple contracts also. That is absolutely okay. So sale index futures on for 15th of December at the rate of 1225, full stop. One contract is entered upon. So this is what we understand. Now on 15th of December what will happen, let us see. On 15th of December there are two situations that they have provided. It is A and it is B. 1225 is the sale value. In case of A, 1260 is the purchase value. Into 1, that is the number of contracts, into 100, that is the lot size. So this is the way we will have 1225 minus 1260 into 100, that comes to loss of 3500. Do not write anything, let me explain you first of all. In the second case it is 1225 minus 1175 into 1 into 100. So the answer comes to an amount of 50,000 rupees. We always know that if at all information is provided to us about the futures contract, then just if at all you enter into one transaction, that will not give an assurance of the profit to you, that will not give you an assurance of arbitrage to you. Why? Because as you have entered into the transaction for sale over here, if at all, so the spot value is more than this, then in that case you are going to incur a loss, and that is a loss that you are incurring over here. So what you have to do, whatever you are going to do, say at the end of the period, reverse of that is the transaction to be entered upon today. So today you will enter into the transaction like this, that buy stock at the rate buy stock at the rate rupees 119500 from spot market, comma, to form a portfolio equal to index. Now dear students, I have told you even earlier that index is only a hypothetical value which is assigned to say certain number of shares. So what happens at say 1195 into 100, that comes to 1,19,500. That is the amount of the investment that say you should make in the existing portfolio, that is in a portfolio which is equal to the existing index. That is what say you should do. How do you come to know that say you have to buy today? Because you are going to sell later on. Because we understand that say entering into only sale transaction will not give a gain to you. So today you have to enter into the reverse of that transaction. So you have to buy stock. In order to buy stock, we assume that say we will borrow rupees 1,19,500 at the rate of 9.5 percentage for 91 days. So at the rate of 9.5 percentage, say you borrow funds for 91 days and you say make investment in the security today. Okay, on 15th of December, what will happen? Let us understand further. This is the profit or loss that we have computed say for the index transaction. Now, the second thing that we understand is this. Calculation of interest expense. We understand that say whatever the borrowing that we have made, for that say the interest is required to be paid. It is PRN upon 100. So what is the amount of the interest? It is 1,19,500 into 9.5 percentage into 91 divided by 365. So into 9.5% into 91 divided by 365. So it is 2830.35. Now friends, importantly, whatever the investment that we have made, for that say we will get the interest income. So we have to prepare one more working note, that is in the 15th of December, calculation of dividend income. Whatever the stocks in which you made investment must have paid interest to you. Must have paid dividend to you, because you have entered into the spot transaction of purchasing of the stock. So the dividend income is equal to 1,19,500 into rate of dividend is 3% and say 3% is per annum. So for 91 days it will be calculated like this. So 1,19,500 into 3% into 91 upon 365. So the answer comes to 893.79. 893.79. This is the dividend income that you have. Next, listen carefully. What happens at say, since you had made investment in the portfolio as per the index, you have made investment in the stock as per the index proportion. So if at all the price increases to 1260 or price decreases to 1175, value of your portfolio will change accordingly. So what will happen? 1260 index and 1175. Value of the portfolio in which you had made investment. 1,26,000, 1,17,500. This is the value of your investment. Add dividend income which you must have received on the investment. The dividend income is 893.79. Then payment of interest for the borrowing of the funds 2830.35. Then repayment of principal. The amount of the principal repayment is 1,19,500. This is the repayment of the principal. Further, we understand that say this is 3,500. That is the profit, and over here, sorry, this is the loss. 1225 minus 1260 into 100. So loss of 3,500 and 1225 minus 1175. So profit of 5,000. So in the first case, loss of 3,500. So we will have the profit or loss in index trading. In the next one, it is 5,000 rupees of the profit. This is the way we will have the final answer. So what will happen? 1,26,000, that is this amount, plus 893.79 minus 2830.35 minus 1,19,500 minus 3,500. So it results into the profit of 1,063.44. Next, 1,17,500 plus 893.79 minus 2830.35 minus 1,19,500 plus 5,000. So that comes to once again 1063.44. And this is what we understand as arbitrage. Whether the price increases or price declines, in either of the case you make a profit. Dear students, you can make the difference of this two. 1225 minus 1214.37, and difference of that comes to exactly 10.63. This is the price at which you have sold, and it is deemed that you have purchased at this price, and difference of that is the amount of the profit that you are able to make per rupee. Okay, and 100 is the lot size. We have entered into one contract, so 1063 into 100, you make a profit as 1063.44. Friends, one important point over here is that we have done similar question wherein it was underpricing or overpricing of a security. So what happened that say we had to make investment only in a security, and while over here it is the index transaction, so you have to make investment in the bunch of the securities, so which is equivalent to the index. That is the difference that we have. So answer for the second question. The second question speaks that what transactions are required. So let us answer for the second question. We can observe that futures contract is overpriced. Full stop. So for the purpose of arbitrage, comma, enter in futures contract to sell underlying asset. That is index futures full stop. As index will be sold in futures, comma, today we will purchase stock worth current value of index, comma, in current proportion. Full stop. In order to invest today, comma, we have to borrow funds. Full stop. Hence, enter in following transactions today. A. Borrow. B. Buy stock. At current price as per index proportion. C. Sell index in futures. Full stop. Third question. Calculate the gain loss if the index on 15th of December closes out at this prices. So let us answer for the third question. Calculation of the profit or loss, comma, for above transactions. Full stop. I'm sorry friends, make it only profit, because this is going to be only profit. Calculation of profit for above transactions. In the write down, transactions on 15th of September. 1. Borrow rupees 1,19,500. 1195 into 100 at the rate of 9.5% for 91 days. Second, purchase shares as per current index from spot market. Third, enter in futures contract for December, comma, to sale index with paragraph write down. We understand that at the end of 91 days, comma, trader will have following position. In the write down A, following position. In the write down working note number 1, calculation of repayment of loan. Principal plus interest 1,19,500 plus 1,19,500 into 9.5% into 91 divided by 365. Dear students, over here the question does not provide the information about the continuous compounding. Otherwise, we would have taken the continuous compounding. Okay. So 1,19,500 plus 2830.35. One lakh 22,330.35. Working note number 2, calculation of dividend income. So whatever the stocks in which you had made investment will pay dividend and you will receive it. It is spot value into rate of dividend into n divided by 12. 1,19,500 into rate of dividend is 3% into 91 divided by 365. So the answer comes to 893.79. This is the dividend income. With paragraph read down, calculation of profit or loss. Sorry, calculation of profit, comma, for each of the index value. Index value 12601175. That is a way two index values in the write down. Value of portfolio. It is 1,19,500 divided by 100 into 1260. Next, 1,19,500 divided by 100 into 1175. So this is the value of the portfolio in which you had made investment initially. Profit or loss in index trading. Your predetermined sale value is 1225. So 1225 minus 1260, difference of that into 100. 1225 minus 1175 into 100. This is a profit or loss in index trading. Next, repayment of loan. This is the repayment of loan. 122,330.35. Next is dividend income. And it is 893.79. 893.79. And this is a way we'll make the calculation of the profit in both the cases. So the first case it will be 1,26,000 in the next case it will be 3,500 negative. So 1,26,000 minus 3,500 minus 122,330.35 plus 893.79. So that comes to 1063.44. And this is given a technical name as arbitrage. Next, it is 1,17,500. 1225 minus 1175, that comes to 5050 into 100. So it is 5,000. 1,17,500 plus 5,000 minus 122,330.35 plus 893.79. So same answer 1063.44. And I already have explained it to you that how you can cross verify this value. Friends, over here in the division it will be 1195. I'm sorry. That is the spot index value. Please write down. So please write down one line answer. In either of the case, there will be a profit of rupees 1063.44. Let us have a quick revision of the entire question. We understand that in the first part of the question we have to make the computation of the theoretical futures price, that is spot plus interest minus dividend, and this time information is provided to us about the index futures. Then we have to answer that say is it overpriced or underpriced. We understand that say actual price is less than what it should have been. Sorry, actual price is more than what it should have been, so it is overpriced. That is the way we have given answer for the first part of the question. The first part of the question is not so important as the second part of the question, in which we are required to give answer that say how you will enter into the arbitrage if at all there is a mispricing. We understand that so then in that case what you have to do, so you are required to enter into the transactions like this. The first thing that we understand that since the price is more than what it should have been, so we should enter into the sale index futures. That is the first thing that should strike in your mind. Second, since you are going to sell index, so today you should enter into the transaction for purchase security. In order to make investment in the portfolio equal to the index, you will borrow funds. So borrow, invest, enter into the F transaction for sale index. That's it. Now what will happen? During these 3 months, so there will be some dividend income that you will receive. That is a payment of interest. When you will square up the futures transaction, you will be having say an amount of the profit or loss. Considering the price at which so the transaction is squared off and the price at which the transaction was entered upon. You enter into the transaction for sale index. So your sale value is predetermined. And so the closing price of the index at that point of time would be the price at which you will purchase it. Importantly, you had made investment say in the portfolio which was say replicating the index. So what will happen? Say whenever there is a change in the index value, so there is a change in your value of the portfolio too. So your value of the portfolio is this: dividend income, payment of interest, repayment of principal, profit or loss in the index trading. In either of the case, say you make a profit only and there may be any other price provided to you, definitely you will end up with the profit only. There is no question of loss. And even this amount of the profit you can cross verify by making a comparison of say this two value. That is the actual that is a futures value and the theoretical futures value.